November 6, 2022. FTX is worth $32 billion. More than 1 million people trust this exchange with their savings. 10 days later, all of it is gone. The story everyone tells is a bad bet gone wrong. But the money was never really there to lose. On November 2nd, a leaked balance sheet exposes something strange. Alameda Research. FTX's private trading arm is holding billions in FTX's own token, not real cash. 4 days later, Binance's CEO announces he's dumping his entire FTT position. Panic spreads in hours, not days. Customers rush to pull $6 billion out in 72 hours. FTX can't pay them. On November 8th, withdrawals freeze completely. Binance offers a rescue deal, then walks away 1 day later. November 11th, FTX filed for bankruptcy, and Sam Bankman-Fried resigns as CEO. The new CEO, a man who once unwound Enron, calls it the worst failure of corporate controls he's ever seen. Investigators soon find an $8 billion hole where customer deposits should have been. That money didn't vanish in a market crash. It moved, quietly, deliberately, long before the world noticed. And the trail leads straight back to a backdoor no exchange should ever have had. Before FTX, there was just a spreadsheet and a strange kind of certainty. Sam Bankman-Fried studied physics at MIT, then walked straight into Jane Street Capital, one of Wall Street's most secretive trading firms. In 2017, he quit a six-figure job to chase a stranger idea. Crypto arbitrage between Japan and the US, worth as much as $10,000 in profit per Bitcoin. That trade seeded Alameda Research, his own quant fund, built on speed and cold math. By 2009, he'd built FTX itself, a crypto exchange promising faster, fairer trades than anyone else on the market. He wasn't just chasing wealth. He pledged to give almost all of it away, calling himself an effective altruist. Reporters loved it. Regulators softened. Investors lined up. Sequoia, SoftBank, BlackRock. Some of the most disciplined names in finance. Poured money in, chasing the boy genius who said he'd save the world with math. By 2021, FTX had over 1 million users trading billions daily, and Sam was on magazine covers comparing himself to Warren Buffett. But behind the image of the rumpled genius in cargo shorts, something didn't add up. FTX and Alameda Research were supposed to be separate companies. They weren't. And that quiet, invisible line, the one nobody was watching, was about to become the story. By early 2022, FTX wasn't just a crypto exchange, it was a cultural juggernaut. Sam Bankman-Fried stood on stage next to Tom Brady and Gisele Bündchen, both now paid brand ambassadors and equity holders. Stephen Curry signed on. So did Shaquille O'Neal and tennis star Naomi Osaka. In June 2021, FTX paid $135 million for the naming rights to Miami's NBA arena. 19 years, one name, FTX Arena. Then came the Super Bowl. February 2022, a national ad starring Larry David, mocking every bad idea in history. Except this one, he said, was different. It wasn't. Behind the scenes, investors were racing to get in. Sequoia Capital, SoftBank, and dozens of funds poured in fresh capital, valuing FTX at $32 billion, double the year before. Sequoia would later publish a glowing profile suggesting Bankman-Fried could become the world's first trillionaire. That article would be quietly deleted within the year. In December 2021, SBF testified before Congress, calm and articulate, calling for sensible crypto regulation. Lawmakers listened. Some even praised him. Meanwhile, FTX and its executives funneled over $70 million into political donations, making Bankman-Fried one of the top donors of the 2022 midterms. He was building something bigger than a company. He was building trust, the one asset an exchange cannot survive without. And investors, regulators, and millions of everyday customers believed every word of it. But behind the marketing, behind the arena, behind the Super Bowl spotlight, a quieter machine was moving customer money somewhere it was never supposed to go. The public saw the most trusted name in crypto. Almost no one saw Alameda Research. That was about to change. Buried inside FTX's own platform, Alameda Research, the trading firm Sam Bankman-Fried also owned, got a secret exemption from the rules every other customer had to follow. No margin calls, no liquidation. Alameda could borrow from customer accounts and go negative, effectively unlimited. By mid-2022, leaked documents would reveal Alameda's balance sheet held $14.6 billion in assets, much of it FTX's own invented token, FTT, not client money sitting safely in custody. Money that belonged to millions of ordinary depositors, traders in Kansas, students in Manila, retirees in Ohio, was quietly flowing into Alameda's trading positions. The backdoor even had a name inside the code, allowing negative balance. FTX marketed itself as the safest place to hold your crypto. Meanwhile, an estimated $8 billion in customer deposits had already vanished into Alameda's bets, loans, and losses. No hack, no market crash yet. Just a line of code, and the people who wrote it decided your money was theirs to use. For over a year, nobody outside a tiny circle knew. But one journalist was about to ask the one question FTX couldn't answer. November 2nd, 2022, CoinDesk publishes a leaked balance sheet from Alameda Research. Of Alameda's $14.6 billion in assets, $8 billion was FTT, a token FTX invented from thin air. It was not money. It was IOUs backed by nothing but Sam Bankman-Fried's own promise. 4 days later, Binance CEO Changpeng Zhao announces he's selling his entire FTT position. Panic spreads across crypto Twitter within hours. Customers start pulling funds. $6 billion in withdrawal requests hit FTX in 72 hours. FTX had promised those funds were always available, always separate, always safe. They weren't, because the money had already been spent. On real estate, on political donations, on failed trades. November 8th, Sam Bankman-Fried tweets, FTX is fine. Assets are fine. Within 24 hours, FTX halts all customer withdrawals. The exchange that promised instant liquidity couldn't produce the cash. Binance signs a non-binding letter of intent to acquire FTX, a lifeline. 1 day of due diligence later, Binance walks away. The reason, what they found inside the books. A whole not of millions, but of billions. The math finally caught up to the myth, and the world was about to learn exactly how deep the hole really went. The number the world had been chasing finally landed, $8 billion, gone. Not lost in a bad trade, never there to begin with. New CEO John J. Ray III, the man who unwound Enron, called FTX worse than anything he'd seen in 40 years of corporate failures. The mechanism was almost embarrassingly simple. A hidden backdoor in FTX's code let Alameda Research spend customer deposits with no limit. One exchange rule every custodian is supposed to follow: never touch client funds. And FTX had quietly deleted it. In November 2022, FTX filed for Chapter 11 with over 1 million creditors owed money. A year later, a jury took barely 4 hours to convict Sam Bankman-Fried on 7 counts of fraud and conspiracy. 25 years. The sentence for building an empire on money that was never his to move. The billions clients thought were sitting safely in their accounts had, in truth, financed real estate, political donations, and venture bets no depositor ever approved. The lesson was old, long before crypto existed. A business isn't safe because it's growing. It's safe because what it promises to hold, it actually holds. Somewhere, in another version of this story, someone enforces that one rule: segregate the funds, and $8 billion never disappears at all.